Hey everyone, welcome back. Ready to do another deep dive.
Always, Ray.
Awesome. Today we're breaking down Tuesday's, that's November 12th, 2024 market action using the latest report from Market Deep Dive. We'll try to figure out what it all means for you, for your portfolio.
Well, right off the bat, the market had a bit of a stumble, after that initial post-election rally.
Yeah.
The report kind of blames it on a few things. Rising Treasury yields making people nervous, some profit-taking after all those gains, little weakness overseas, and maybe some folks just being cautious, waiting for the inflation data, the CPI, later this week.
Yeah, that makes sense. Let's unpack those Treasury yields first. The report mentioned the 10-year note jumped to 4.43%. Um, for those of us who don't live and breathe the bond market, what's it actually telling us?
Basically, it means investors are thinking tighter monetary conditions are coming. Think of it this way. When those yields go up, it often means investors think the Fed's going to raise interest rates. And when borrowing gets more expensive, well, companies feel it, especially smaller ones and those that pay dividends. Their growth might slow down, making them less attractive to investors.
Interesting.
That's probably why sectors like home builders and small cap stocks, they had a rough Tuesday. They're really sensitive to those interest rate hikes.
So rising Treasury yields, definitely something to watch, especially if you're invested in those companies. Now, the report also talked about the U.S. dollar getting stronger, hitting its highest point since like early May. What's behind that?
The report's linking it to, well, potential policy changes, things that could help the U.S. economy grow. Less regulation, lower taxes, maybe even more tariffs.
Okay.
A strong dollar can mean investors are feeling good about the U.S. economy. But it also impacts international trade and investments. So, something else to keep in mind.
Gotcha. So policy changes are already making waves. And speaking of waves, the report showed how different sectors are doing post-election. Tech, financials, communication services, they're all doing pretty well. But materials, utilities, and consumer staples, they're lagging behind.
Well, it makes sense if you look at what the market's expecting. Investors are putting money into the sectors they think will benefit from the, well, anticipated policy changes. More government spending, fewer regulations, possible tax cuts. Tech, financials, communications, they're often seen as the big winners there.
Winners and losers, huh? Speaking of, Tesla's been on a roller coaster. Huge surge after the election, then dropped 6% on Tuesday.
Oh yeah, Tesla's a perfect example of how volatile things can be, especially now. It's super sensitive to news and external factors like those potential policy shifts we talked about. The initial jump was probably just optimism, but Tuesday's drop shows how fast things can change.
No kidding. All right, let's zero in on some specific companies. The report highlighted a few earnings reports. Tyson Foods, they crushed it, beating expectations. Lots of demand for beef, and feed costs are down.
Right.
Shopify had a great showing too. Impressive e-commerce numbers, and they're looking good for the holidays.
Shopify's success is interesting. It could be a sign of things to come for the whole e-commerce sector. The report even suggests it could be good news for other giants like Walmart as we head into the holiday shopping season.
Okay, so potential good news for shoppers there. Then there's Home Depot. They beat earnings and revenue estimates, but they're still dealing with that tough housing market.
Yeah, it's a mixed bag for Home Depot. They did better than expected, but the housing market is still a drag. Lower comparable sales and their operating margin are proof of that. It'll be interesting to see how they handle things going forward.
For sure. Now, for all of us watching inflation like hawks, the CPI and PPI reports coming out soon are going to be huge.
Yeah.
The report really emphasized how important those are for figuring out where inflation's headed.
Oh, absolutely. It's like taking the economy's temperature. They give us clues about price trends, and they play a big role in the Fed's interest rate decisions.
And speaking of those decisions, analysts think October's CPI will go up a little, but the report warned us that the year-over-year numbers might be misleading. Remember, inflation was dropping fast a year ago.
Right, that's key. The Fed's not just looking at a single point in time. They're focused on the trend, over 3 to 6 months. They want to see consistent progress, not just a one-time thing.
So that brings us to the big question. Will the Fed keep cutting rates? The report hinted they might be hitting the brakes.
Yeah, this is where it gets interesting. The report pointed to this survey, the Senior Loan Officer Opinion Survey, or SLS. It shows banks are being more careful, tightening lending standards, especially for big companies. We're also seeing less demand for loans overall.
So if businesses aren't rushing to borrow, does that mean the economy might not need as much help from the Fed? Like less need for rate cuts?
Exactly. Could be a sign businesses are doing okay, don't need that extra boost from lower rates. Plus, the report mentioned corporate balance sheets are strong and credit spreads are low, all pointing to a more resilient economy. This gives the Fed some wiggle room to adjust rates without causing too much disruption.
It sounds like the market's already factoring in fewer rate cuts. The report said those rising Treasury yields are partly due to concerns about the new administration's policies, like how those might impact the Fed's ability to stick to its plans.
That's a crucial point. The market's always trying to predict the future, right? And right now, there's a lot of uncertainty inflation, interest rates, new policies. It's like a puzzle with missing pieces.
A lot to keep track of, even for experienced investors. So let's shift gears a bit. What does all this mean for everyday investors? The report had some specific advice. Anything jump out at you?
Well, I think the main takeaway is we're in a transition period. The election shook things up, new expectations, new sentiment, and that creates both opportunities and risks. Retail investors need to recognize that and adapt.
Okay, so how do we adapt? What kind of adjustments should investors be thinking about?
First, take a fresh look at your portfolio. Make sure you're not too concentrated in one area. We saw how different sectors reacted to the election. Diversification is key. Spread your investments across industries that could benefit from the policy changes, but also consider keeping some money in more stable sectors, like consumer staples. Those tend to hold up better during uncertain times.
Diversification, always a good strategy, especially now while things are still settling. What else?
Check your risk tolerance. The market is naturally volatile and things are even more amplified right now. If you're not comfortable with the level of risk in your portfolio, make some changes. Shift some funds to more conservative investments or just reduce your overall exposure to the stock market.
Manage your risk. Don't be afraid to adjust. Any particular sectors or companies investors should have on their radar?
The report pointed to some interesting trends. Shopify is doing great, which suggests e-commerce is still a strong area, even with the economic uncertainties. We also see tech, financials, and communication services getting a lot of attention due to those anticipated policy changes. But, as always, do your own research before investing in anything specific.
Absolutely. Don't just follow the hype. Do your due diligence.
Exactly. And don't underestimate earnings reports. They tell you how individual companies are handling things.
Speaking of, we talked about Tyson Foods and Shopify, but what about First Solar? The report mentioned they took a hit, reflecting the challenges for alternative energy companies post-election.
Yeah, a prime example of how political shifts can impact certain sectors. Investors are reacting to potential policy changes, and that's affecting sentiment towards alternative energy. We'll have to see how that plays out long term.
And then there's Home Depot, a bit of a mixed bag, beat earnings expectations, but those housing market struggles are still there.
It reminds us that even within a sector, there are winners and losers. You gotta look beyond the headlines and understand what's really driving each company's performance.
We've covered a lot of ground today. Market downturn, potential policy impacts. It's clear there's uncertainty ahead, but also opportunities for investors who stay informed and adaptable. Before we wrap up, let's go back to those inflation reports, the CPI and PPI. Sounds like those could really shake things up.
Definitely could. The market's already on edge about inflation, and those reports will give us the latest update. If the numbers are higher than expected, it could spook investors and lead to more volatility.
So everyone listening, mark your calendars for those releases. We'll be watching them closely too.
And remember, the Fed will be watching too. They'll use that data to decide on interest rates, which could impact the entire market.
All right, folks, that's a lot of information. Let's do a quick recap for our investor audience. What are the key takeaways?
Here are the main points. 1, the market's in transition. Sentiment and expectations are shifting post-election, creating both opportunities and risks. 2, diversification is key. Spread your investments across various sectors to minimize risk. 3, manage your risk tolerance. If you're uncomfortable, make adjustments. 4, stay informed. Keep up with market news, especially those earnings reports and upcoming inflation data. 5, be adaptable. The market's always changing, so be ready to adjust your strategy.
Great takeaways. Thanks for breaking it all down.
My pleasure. Always enjoy these conversations.
Now, before we let everyone go, a thought-provoking question. The report mentioned the Treasury market has been factoring in less Fed support for the past 2 months. So, with all this uncertainty around inflation and interest rates, what does this say about the market's confidence in the Fed's ability to handle these challenges and keep the economy going?
That's a great question. Those rising Treasury yields suggest some skepticism about the Fed's ability to stay the course, almost like the market saying, we're not totally convinced you've got this.
So, does that mean investors are expecting the Fed to change course? Maybe end those rate cuts sooner than planned or even raise rates down the road.
It's definitely possible. Remember, the market's always looking ahead, trying to anticipate what's next. If investors think inflation's going to stick around longer than expected, or that the Fed might have to get tougher than they've been saying, well, that would explain those rising yields.
It's like the market's trying to account for those scenarios before they even happen.
Exactly. That's why it's so important to pay attention to these signals. They can give you clues about what the market's collectively thinking.
So, for our listeners trying to make sense of all this, what's the bottom line? How should they think about these signals and what they could mean for their own investments?
I think the most important thing is to stay flexible. Don't get locked into one specific outlook or strategy. Be ready to adapt as things unfold. For example, if you're heavily invested in growth stocks, those are really sensitive to interest rates, it might be a good idea to diversify into other areas that might be less affected by rising yield.
Good point. Diversification is key, especially now.
Absolutely. And don't forget about patience. The market goes through cycles, and those short-term swings are normal. Don't panic and make rash decisions based on daily movements. Stick to your long-term goals and adjust your strategy as needed.
Great advice. Thanks for sharing your insights today. It's been a really interesting look at what's moving the market right now.
My pleasure. Always happy to help break it all down.
And to all our listeners, thanks for joining us on this deep dive. We hope you found it helpful and informative. Remember, stay informed, stay adaptable, and most importantly, stay curious.
And as always, remember that investing involves risk. Do your research, talk to a financial advisor if you need to, and make decisions that align with your own goals and risk tolerance.
Until next time, happy investing.